Hello, Keith Prather here again this month with the NCM Marine Demand Index report. And let me flip over there. So this month is kind of interesting. We did see a dive in the overall leading index. And remember, the leading index is a series of economic data that we put into a formula. And what it spits out is a leading index. So it's looking at over the next 6 months to try and help you understand what the environment looks like. And obviously, it's feeling a lot of pressure from, what's happening with trade, what's happening with tariffs, a little bit of job uncertainty, and it's just getting a very slow start to the year. So we see it being about 1.8% lower month over month and was 1.5% lower year over year. And you can see it here that is still trending below the long-term trend. So we don't like the direction in where the index is going, but there was some other interesting bright spots kind of in the market. So we're hoping that this bounces back for us maybe in April or May when we start to see maybe some trade deals get struck. We start to see maybe a little bit of easing of the tariff pressure and that hopefully this will start to take off for us. Um, so the producer price index for boat building, though, the material side of things, the cost side of things is still going up. So even though it was a little bit lower month over month, and was a little bit lower year over year when you kind of compare it to where we were a year ago, we have seen a little bit of acceleration since September of last year. Nowhere near where we were, going back to just coming out of the recession, or I'm sorry, out of the pandemic, and we had the global supply chain challenge in 2021 and 2022, and that's what this super spike in cost was, and the actual producer side. So producer prices are still pretty low historically when you go back, but again, starting to see it inching up just a little bit in the latest trends. Nothing to be worried about, but this is where we would pick up some of the tariff impacts. I have talked to a lot of folks in the boat construction industry, and I know that they're concerned about some of the USMCA regulations and making sure that they're certified to be able to move things cross border without any tariff impact. The actual content of foreign material in most boats is, and, I have to specify that. I know there's a lot of different categories of boats, but in many categories we see a lower foreign content than maybe you do in automotive, and some maybe a number of other industries. And so a lot of the tariff impact ought to be fairly muted for the industry. You see maybe some of the electronic components, you see some of the engine components, but not as much as we would see maybe in other components of the boat. So we don't know if tariffs will have a huge impact, and we didn't see it yet showing up through the March data. But again, we'll have to wait for April and May and look and see what that looks like overall. So just looking at retail trade, we're going to be using this across all of the videos this month. So we modeled early on before the tariff impact from April 2nd, and what we were getting was a retail signal that shows the consumer spending, which is still 70% of GDP, looked to be pretty strong for the year. So you can see this really strong growth rate, followed by just a little bit of softening, but obviously a good demand environment overall. And then after April 2nd, when we got the reciprocal tariff announcements, the stock market, a lot of different economic measures adjusted very quickly. And so we were able to incorporate a lot of those changes into this April model. And this is what it did. So this is how much it softened by. And it was, to be honest with you, less than expected. We all kind of expected a retail curve that kind of flattened out and if not decelerated. But what we saw was a retail model that looks like we see a little bit of softening through May, but then it accelerates through the end of the year, and we have a pretty good retail year. That would suggest a very strong consumer, a consumer that's building a little bit of confidence in the second half, and one that isn't seeing a major drop off. And so we're going to continue with that. Again, we see nothing, at least on the horizon, that looks recessionary at all. And so that's still a good positive signal. So it's interesting, and I know it doesn't affect so much what we see with the NCM boat sector, but commercial shipbuilding right now is probably going to get a boost from Trump administration policy. We know there's a lot more defense spending going into the naval industry and the defense side of shipbuilding, but also with the Chinese-built ship duty, which imposes a tax on Chinese-built ships that will be docking at U.S. ports, and that kicks in October, and it's even twice as high if it's a Chinese company, at least for now, using a Chinese-built ship docking at a U.S. port. And they believe, and what he's hoping is that that will help fuel some commercial shipbuilding expansion. Again, not a direct impact on the NCM industry so much, but we think that there's maybe some spillover into the recreational industry, and that just the headlines that will be garnered by this whole move and maybe an expansion of the shipbuilding industry will just help bring a little bit of awareness to boating and going out and kind of doing some of the fun recreational side of things. So we'll see what happens, but we're going to watch that. It also could create a little bit of competition for some of the materials used in some of the products. I know that the materials are very, very different between, a naval vessel and a commercial ship, but some of the electronic components that go into some of the things that we use, everything from depth finders to navigational equipment, some of those materials are going to be very similar, and some producers, some suppliers may be tempted to shift some of their production to go toward maybe a bit of a more lucrative market, whether it's the defense side or commercial shipping. So we'll see what happens. I mean, in general, I know the recreational side is going to still be very good. It's going to be, growth oriented, I think, as we move forward, especially as we've talked in the past about this great wealth transfer as the baby boomer generation starts to transfer their wealth into younger generations. And, many in their, 20s, 30s, and 40s are going to come into some extensive wealth that they haven't had before, and many will use it to go out and buy big ticket recreational items like some of what we see in the boating industry. So we think the Fed is going to probably step in, probably not before June. At the time I was recording this, we were waiting on a Fed decision in April, or sorry, early May. But we think they'll probably wait till June before they do their first 3/4 point or the first quarter point cut. They were expecting 3/4 point cuts in all of 2025. June being the first, and maybe we get the second in September, and then by the end of the year, if things are still not growing fast enough, you may see a December cut. There is some inflation risk on the horizon. We know that in Q1, when we looked at the consolidated inflation growth rate, it was about 3.7%, which is higher than the Fed's 2% target rate and is higher than what we've seen over the last several months. We're getting these monthly figures of somewhere around 2.7%. So it's much higher. We'll look and see what tariffs do to this, but that could pause the Fed. That could stop the Fed from moving. And that's why a lot of folks are kind of expecting them not to do anything in May. We're also still watching the 10-year Treasury. So for long-term borrowing, we think about really long-term boat loans. We think that the rate's going to get below 4% by this summer. Now that's the 10-year Treasury rate. And then the borrowing, what consumers would pay, in interest on top of that for mortgages somewhere around 1.7 points above that. So if we're at 4% on the Fed rate or the 10-year Treasury rate, it creates a mortgage rate of about 5.7%. So that's pretty exciting, and we start to get it down into those levels. The minute the 10-year Treasury goes below 4%, you're going to see a lot of households refinance their mortgages. Those especially who have bought in the last couple of years at high interest rates, a lot of them will go in and refinance, and that frees up a lot of monthly income for things like buying a boat. And so we're going to watch for that because I think that could be a good catalyst. Job market right now has uncertainty in it, but right now it really remains stable. We still see, almost 1.4 million excess jobs available over what we would consider to be a normal market. We're still seeing wage growth of almost 4%. It's about 3.8. And again, as long as inflation stays below that 3.8, a lot of households are going to continue to do very well. So we'll continue to watch that, but for now, the job market is pretty stable. Unemployment is fairly low. And then the last thing is just watch for a wave of trade deals to get announced between now and July. And then also sometime early in July, we think there's going to be a tax bill that gets signed. And then on top of that, we think inside that tax bill is going to be some really good corporate incentives, maybe dropping the corporate tax rate down to 15%. We'll look and see once it all gets negotiated what's really in that bill. But those could be the catalyst to create a rapid growth environment for the second half of the year. Again, we need to see what's in that very first trade deal. We need to look and see what happened to tariffs. Hints from the U.S. Treasury Secretary say that some of the deals that are coming across now could show a major reduction in tariffs from where they were prior to April 2nd. So you think about Vietnam has imposed a 9.2% tariff on US goods over the last decade or two. You could see that tariff go to zero after negotiations. So a lot of moving parts, a lot of things that could change between now and then, but that's kind of where we're at. The first quarter came in fairly flat, came in down 0.3%. We think after adjustments, it probably would came in flat overall. Q2 looks like it's going to be somewhere between 0.5% and maybe 1% growth. Again, depends on how those trade deals come in and sort of what the July tax bill announcement looks like. For the second half of the year, though, assuming that those things go well and that somehow the Chinese tariffs come down from current levels down into a 20 or 30% tariff rate, you're looking at decent second half growth. And I think that's probably where we're going to net out. That would bring the whole year, no recession, but growth of about 1.5%. There's still many, many risks out there. A lot of things that could still send us into a mild recession, but nothing feels as dark and deep as like the 2008 financial crisis or maybe what we ran into during the lockdown period of COVID. So that's kind of where we're at. Moving forward, again, I think it's going to be a pretty good second half of the year. Again, we're going to watch for some things that can blow that up and send it the opposite direction. But for now, I think it's good to probably stay optimistic, and we still have a decent consumer. The consumer just needs some things to feel more confident about, and once they get that confidence, then I think they'll start to accelerate. So, okay, hope everyone is doing well. Hope you have a great month, and we'll see you next month. All right, take care. Bye bye.